I'm Richard Murphy. I've made a video explaining what money is. Money is just a promise to pay, I said. And I explained that there is no intrinsic value in one of those things. They're not worth 20 quid. They're worth £20 because the government has promised to give you value of £20. And I explained that there's nothing behind your bank balance. There's no gold, there's no silver, there's nothing else. There's just a printed balance on your bank statement. There's not even notes and coins. So how does the banking system work if money is just a promise to pay? Well, let me explain, because it doesn't work the way that most people think. And it's really important that you understand this. When you go into a bank, if you go into a bank and ask to borrow money, and people do this every day all over the world, either in person or now online, what happens is you ask, can I borrow, let's use an example, £10,000. You want to buy a second-hand car. That car is owned by a garage that you want to make payment to. You tell the bank that this is your intention. The bank doesn't just say yes to you. What the bank does is go and check out your credit reference. Why does it check out your credit reference? Because it wants to make sure whether you can fulfill your promise to pay them. Remember, I've already said that banks work on the basis of promises to pay. Well, so do you. When you borrow money from a bank, you promise to pay the bank. What the bank promises to you is that if you make a promise to them, they will make a payment to the garage for your car, or whatever it is that you want to buy. That is how banking works. There are just two promises that create money. One is yours to the bank to repay whatever you want to borrow. One is the bank's, that they will pay whoever you tell them to. There's nothing more to it than that, to literally create money in the banking system. And this is true of banks everywhere. Now, what does that mean? It means that when a bank lends you money, it does not lend you somebody else's money. The bank doesn't have to go and look in its vaults to see if there's a pile of notes, coins, gold, silver, or anything else there to be able to lend the money to you for you to pay the bank. That's not how it works. Because the garage, or whoever it is you're going to pay, knows just as you do that banks in the UK, and I'm talking about banks in most developed countries, have simply not failed for a long time. They don't fail because, first of all, governments make sure they have enough money not to do so, and I'll come to that in another video. And second, they don't fail because actually governments effectively guarantee that they won't these days. So, they don't fail. Therefore, they don't need money in the bank to make settlement to that other person who you told them to make payment to, because that other person also accepts the bank's promise to pay. And in fact, they will transfer that bank's promises to pay into their bank account. And the banks have arrangements with each other to back up their promises to pay. But this is how banking works. You promise to pay the bank, they promise to pay someone else, and between the two of you, you did something amazing. You made money. You literally made money out of thin air. There was no money to pay that £10,000 before you went in, but because of your mutual promises, you made that money, and that money was then used to pay somebody else. And that's how you and banks make the money to make the world go round. Thanks for watching. If you're interested in what I've been saying in this video, please subscribe. There is a button below the viewing screen. If you're interested in what I have to say on Twitter, I'm at Richard J. Murphy on that medium. If you want to look at my blog, that's taxresearch.org.uk, and we have a Facebook page as well, Richard J. Murphy. So one of those things will get you more information on what this video series is about, and I hope I'll see you again soon.